With SpaceX reportedly preparing for a June IPO that could value the company anywhere between $1.75 trillion and $2 trillion, investors are increasingly asking the same question: how do you get your hands on some SpaceX stock right now before it officially hits the public markets? The good news is you do not need to reach for inaccessible private deals to position yourself ahead of the IPO. There are already several stocks and publicly traded ETFs that offer indirect exposure to SpaceX by holding stakes in related private holdings or investing across the broader space and innovation ecosystem. In this video, we're revealing 5 stocks that smart money is quietly accumulating before what could become the biggest IPO in market history. More importantly, one ETF is trading around $19, a price that could look incredibly cheap years from now if the space economy expands the way many industry insiders expect. Let's begin with the first stock, Rocket Lab, ticker symbol RKLB. When most people think about the future of space, they immediately think about one company, but the reality is that no industry worth trillions of dollars is ever dominated by a single player forever. That is exactly why investors have become increasingly interested in Rocket Lab, ticker symbol RKLB. Rocket Lab is often described as the closest publicly traded company to a pure-play SpaceX investment. While the scale difference between the two businesses remains enormous today, Rocket Lab has spent years building capabilities that could allow it to capture a meaningful share of one of the fastest-growing industries on Earth. The reason this company matters has very little to do with short-term stock price movements and everything to do with infrastructure. Space infrastructure is becoming increasingly important for governments, defense agencies, telecommunications companies, scientific organizations, and commercial enterprises. Satellites need to be launched, spacecraft need to be built, payloads need to reach orbit, national security assets need reliable deployment. Rocket Lab operates directly within these critical areas. Unlike many smaller aerospace companies that focus on only one segment of the value chain, Rocket Lab has built a vertically integrated business model. Management controls spacecraft manufacturing, launch services, engineering, and numerous critical components internally. That approach gives the company greater control over quality, scheduling, production timelines, and costs. Vertical integration has been one of the major competitive advantages that helped SpaceX dominate the launch industry. Rocket Lab is attempting to replicate many of those same efficiencies on a smaller scale. According to company leadership, controlling more of the production process creates significant advantages compared to competitors relying heavily on outside suppliers. And so far, investors appear to like what they are seeing. The stock has delivered extraordinary performance during 2026. Yet despite that strong run, many investors believe the biggest opportunity may still be ahead. The first reason is revenue growth. Rocket Lab recently reported a record-breaking first quarter, generating approximately $200 million in revenue. That represented year-over-year growth of roughly 63%. For a company already operating at this scale, those are impressive numbers. Rapid growth becomes much more meaningful when it occurs alongside expanding customer demand. And that is exactly what Rocket Lab is experiencing. The company's backlog has now surpassed $2 billion and more than doubled compared to the previous year. A growing backlog often serves as one of the strongest indicators of future revenue visibility because it reflects contracted business that is yet to be delivered. Think about what that means. Customers are not simply expressing interest, they are committing capital, they are signing contracts, they are reserving launch capacity, they are trusting Rocket Lab with increasingly important missions. That level of demand suggests management is solving real-world problems for real customers. But perhaps the most exciting development involves what comes next. Rocket Lab's future is heavily tied to a vehicle called Neutron. Today, the company is known primarily for launching smaller satellites using its Electron rocket. That business has been successful. However, Neutron has the potential to dramatically expand the company's addressable market. Neutron is designed as a medium-lift rocket capable of carrying substantially larger payloads. That matters because larger payload capacity opens doors to bigger contracts, larger commercial opportunities, national security missions, satellite constellations, and potentially a much wider customer base. In many ways, Neutron represents Rocket Lab's transition from a niche launch provider into a much broader aerospace platform. Investors are watching development progress very closely. The encouraging news is that management continues to indicate that development remains on schedule. That progress has already helped Rocket Lab secure what management described as the largest launch agreement in company history. Whenever a growth company reaches an important inflection point, investors should ask a simple question: what happens if execution continues? For Rocket Lab, successful execution could create a powerful combination: growing launch volume, higher revenue, expanding margins, improved economies of scale, and eventually, profitability. The path toward profitability has become increasingly visible as the company expands operations. Recent financial results showed meaningful improvements in adjusted EBITDA performance while revenue and gross margins continued moving in the right direction. That combination is important. Many growth companies can increase revenue, far fewer can improve operating efficiency at the same time. The market is essentially betting that Rocket Lab can continue accomplishing both objectives simultaneously. Of course, no investment discussion would be complete without examining the risks. Rocket Lab is not a low-risk stock. The company trades at a premium valuation relative to current revenue. Investors are paying for future growth, not present-day earnings. That means expectations are high. Any significant delays involving neutron development could pressure investor sentiment. Unexpected cost overruns could create challenges. Execution mistakes could slow growth. Competition remains intense. The aerospace industry is not forgiving. Projects are expensive. Engineering challenges are complex. Customer expectations are demanding. Yet many long-term investors view these risks as acceptable because of the potential size of the opportunity. The global space economy continues expanding. Launch frequency is increasing. Satellite deployments continue growing. Governments around the world are increasing investment in space-related capabilities. Commercial applications are becoming more sophisticated every year. If these trends continue over the next decade, Rocket Lab may find itself participating in a market far larger than the one it serves today. That possibility becomes even more interesting when viewed through the lens of the upcoming SpaceX IPO. Many analysts expect the IPO to attract enormous institutional attention toward the broader space sector. Some estimates place SpaceX's valuation between approximately $1.7 and $2 trillion, potentially making it the largest public offering in history. Whenever a major industry leader goes public at a massive valuation, investors often begin searching for related opportunities. They look for suppliers, competitors, partners, infrastructure providers, businesses benefiting from similar secular trends. Rocket Lab frequently appears near the top of those lists because it offers public market investors direct exposure to launch services and space systems. The market has already begun pricing in some of that enthusiasm. Investor interest across space-related equities has increased significantly as SpaceX's public debut approaches. Still, many investors argue that if Rocket Lab successfully executes its long-term strategy, today's valuation may eventually look much smaller relative to future revenue potential. That is ultimately the core investment thesis. Not that Rocket Lab becomes SpaceX, not that Rocket Lab dominates every segment of the industry, but that Rocket Lab becomes one of the essential infrastructure companies supporting a rapidly expanding space economy. If that happens, the company could create substantial shareholder value over the coming decade, and that possibility explains why so many growth-focused investors continue watching Rocket Lab closely as one of the most compelling publicly traded beneficiaries of the coming space boom. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second company on this list is where things start to feel less like traditional investing and more like positioning yourself inside an industry that is still being built in real time. Redwire, ticker symbol RDW, is not trying to become the next consumer tech giant. It is trying to become one of the foundational industrial players in space infrastructure. And that distinction matters more than most investors realize, because while headlines tend to focus on rockets launching into orbit, the real long-term value in space is increasingly shifting toward what happens after launch. What gets built in orbit, what gets maintained in orbit, and what gets deployed across thousands of satellites and systems operating beyond Earth. This is where Redwire operates. The company focuses on space infrastructure technologies, including satellite components, deployment systems, and in-orbit servicing capabilities. These are the less visible but absolutely essential building blocks of the modern space economy. If Rocket Lab is about getting to space, Redwire is about functioning in space. That is a very different value proposition. One of the most important long-term drivers behind Redwire is the rise of satellite constellations. These are large networks of satellites working together to provide global coverage for communications, imaging, defense intelligence, and data transmission. As these networks scale, the demand for reliable, lightweight, and high-performance components increases significantly. Redwire positions itself directly inside that supply chain. It builds technology that helps satellites operate longer, perform better, and execute more complex missions once they are in orbit. And in a market where reliability is everything, specialized engineering becomes a powerful competitive advantage. The company has also been actively expanding through acquisitions, consolidating niche aerospace capabilities into a broader platform. This strategy is important because the space industry is still fragmented. Many critical technologies are developed by small specialized firms rather than large integrated providers. Redwire is attempting to bring several of these capabilities under one umbrella. That gives it exposure to multiple revenue streams across different segments of the space economy. Now let's talk about the financial picture. Redwire has been in a transition phase, moving from a highly specialized aerospace supplier into a more diversified space infrastructure company. Revenue has been growing, but profitability has remained inconsistent as the company invests heavily in scaling operations and integrating acquired businesses. This is a common pattern in early-stage industrial consolidation stories. Revenue expands first, margins follow later. The key question investors are asking is whether Redwire can successfully integrate its acquisitions while maintaining operational discipline, because if it can, the upside scenario becomes significantly more interesting. A company positioned at the intersection of satellite infrastructure, defense contracts, and commercial space systems could benefit disproportionately from rising space spending over the next decade. And that brings us back to the SpaceX IPO. While Redwire is not a direct competitor to SpaceX, it operates within the same expanding ecosystem. If SpaceX successfully brings more attention and capital into the space industry, suppliers and infrastructure providers often experience secondary demand effects. More launches require more payload components. More satellites require more hardware. More orbital activity requires more servicing solutions. In other words, Redwire does not need to win the entire space race. It just needs the space race to grow. However, investors should also understand the risks clearly. This is a company still working toward consistent profitability. Integration risk from acquisitions is real. Competition from larger aerospace contractors is always present. And execution must remain precise in an industry where mistakes are expensive and highly visible. But despite those risks, Redwire continues to attract attention because it represents something rare in public markets. A direct play on the infrastructure layer of the space economy at a relatively early stage of development. Now we move to the third stock, ERShares Private-Public Crossover ETF, ticker symbol XOVR. Unlike the previous two companies, this is not a single business. It is a fund designed to give investors exposure to both private and public companies that are driving innovation in disruptive industries, including aerospace and space technology. This ETF is currently trading at $19.53 at the time of this video. The reason XOVR matters in the context of the SpaceX IPO is simple. Reports indicate that the ETF carries one of the most concentrated SpaceX exposures available in the public markets, with SpaceX making up close to 20% of the portfolio, or roughly $230 million in value. That position makes SpaceX by far the dominant holding in this $459.7 million fund, which is approaching its 9th anniversary this November. One of the biggest challenges for retail investors is access. By definition, companies like SpaceX are private, meaning most investors cannot buy shares directly before an IPO. Funds like XOVR attempt to bridge that gap by holding a mix of publicly traded innovation companies alongside selected private market exposure where possible. This structure gives investors a way to participate in the broader ecosystem rather than trying to pick a single winner, and that concept is extremely important right now, because as SpaceX moves closer to public markets, investor attention is not just focused on SpaceX itself. It is spreading across the entire innovation stack that supports it. From launch providers, to materials companies, to satellite operators, to infrastructure platforms, XOVR is designed to capture that broader trend. Its portfolio is concentrated in companies involved in disruptive technologies, with an emphasis on long-term innovation themes rather than short-term trading dynamics. The benefit of this approach is diversification across the space and innovation ecosystem. Instead of relying on one company to outperform, investors are effectively betting on the overall direction of technological development. This ETF is best for investors whose primary objective is maximizing SpaceX exposure before the IPO. However, there is an important trade-off. Because it is an ETF, performance is inherently diluted compared to owning the single best-performing asset in the basket. If one company significantly outperforms the rest, that upside is shared across the entire fund. That said, for many investors, this trade-off is acceptable, especially when the goal is exposure to an emerging theme rather than concentrated risk in a single stock. And that brings us to the broader question: why are funds like this gaining attention now? The answer comes back to anticipation. As the SpaceX IPO approaches, capital is beginning to reposition itself around space-related innovation. Investors are asking a simple question: how do I participate in this trend without relying on a single private company? XOVR represents one of the answers to that question. It is not a direct bet on SpaceX, but it is a bet on the ecosystem that SpaceX is helping accelerate. and that ecosystem includes launch providers, satellite technology companies, and infrastructure firms that could all benefit from rising global investment in space. Now here is where things become even more interesting. Because while Rocket Lab and Redwire represent operational exposure to the space economy, and XOVR represents diversified thematic exposure, the next two companies shift the focus towards something slightly different: energy infrastructure and satellite communications. And that is where the story begins to connect with global demand in a much broader way. Before we move into those, there is an important message. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The fourth company on this list is not a space company in the traditional sense, and that is exactly why it matters. Linde, ticker symbol LIN, operates in one of the most overlooked but essential layers of the entire industrial economy. It is the world's largest industrial gases company. At first glance, that might sound disconnected from rockets, satellites, and space exploration. But once you understand how modern aerospace systems are built, tested, and operated, Linde becomes significantly more relevant. Spaceflight, satellite manufacturing, propulsion systems, and even ground testing infrastructure all rely heavily on industrial gases. These include oxygen, hydrogen, nitrogen, helium, and other specialized gases that are critical for propulsion, cooling systems, pressurization, and advanced manufacturing processes. Without these inputs, modern aerospace engineering simply does not function at scale. Linde sits at the center of that supply chain. What makes Linde particularly powerful as an investment in this context is not speculative growth, it is structural demand. The company operates in a highly consolidated global market with significant barriers to entry. Building industrial gas infrastructure requires massive capital investment, regulatory approval, long-term contracts, and deep technical expertise. Once Linde establishes a supply relationship with a customer, it tends to be extremely sticky. That creates a business model built around long-duration contracts and predictable cash flow generation. Now, unlike earlier stage space companies, Linde is not dependent on the success of any single industry. It already serves healthcare, manufacturing, energy, electronics, and chemicals. But the aerospace and space sectors represent an increasingly important growth vector. As satellite production accelerates and launch frequency increases, demand for high-purity gases and specialized industrial inputs rises alongside it. This creates a quiet but meaningful link between Linde and the broader space economy. And when investors begin rotating capital into space infrastructure themes ahead of a major catalyst like a SpaceX IPO, companies like Linde often get overlooked despite their foundational role. Because they are not exciting, they are not speculative, they are not headline-driven, but they are essential, and in long-term industrial cycles, essential often outperforms exciting over time. Linde also benefits from strong global pricing power and efficiency improvements driven by scale. The company has consistently demonstrated the ability to generate strong operating margins and reliable free cash flow, which has made it a core holding for many institutional investors. In the context of this video, Linde represents stability within a highly speculative theme. It is the anchor in a portfolio that otherwise leans heavily toward innovation and early-stage growth. Now we move to the final stock. The fifth company is EchoStar, ticker symbol SATS. EchoStar operates in the satellite communications and connectivity space, an industry that is becoming increasingly critical as global demand for data transmission continues to accelerate. What makes EchoStar interesting in this specific context is its positioning within satellite infrastructure and communication services. Even though EchoStar is best known for its satellite television business, Dish Network, the more interesting angle for investors comes from its agreement with SpaceX. If regulators approved the deal, EchoStar would sell spectrum to SpaceX and, in return, receive shares that could translate into roughly a 2.8% stake in the company. At a hypothetical SpaceX valuation of $2 trillion, that position alone would be worth about $56 billion. EchoStar shares have already climbed more than fivefold over the past year as investors increasingly price in its exposure to the broader space economy. Still, with a current market cap of around $36 billion, the potential value of its SpaceX-linked stake suggests there may still be room for further upside if the deal is approved and the IPO narrative continues to strengthen. As more satellites are launched into orbit, the demand for ground-based infrastructure, spectrum management, and communication relay systems increases significantly. EchoStar plays a role in that ecosystem through its satellite services and telecommunications capabilities. This is not a speculative early-stage company trying to prove its technology still works. It is a long-established operator with real infrastructure, real customers, and real revenue streams. However, what makes EchoStar particularly relevant right now is the broader shift happening in global connectivity. The world is moving toward a hybrid communications model, terrestrial networks combined with satellite-based systems to deliver global coverage in remote, underserved, or high-demand regions. This trend is accelerating due to defense needs, global internet expansion, maritime connectivity, aviation systems, and emergency communication infrastructure. EchoStar sits directly inside this transition, and as SpaceX continues to expand satellite-based internet services through its broader ecosystem, investor attention naturally begins to expand toward other satellite communication providers. This creates a thematic overlap between SpaceX-driven innovation and existing public market infrastructure providers. From a financial standpoint, EchoStar has faced volatility in recent years, but it remains an established player with long-term contracts and recurring revenue components. The key investment question is whether the company can successfully adapt to the rapid evolution of satellite technology and maintain relevance in a market that is becoming increasingly competitive and capital-intensive. Because if it can, then EchoStar becomes more than just a legacy communications company. It becomes part of the backbone of global satellite connectivity, and that is a powerful position to hold as demand for global data transmission continues to rise. What ties all 5 of these stocks together is not just their individual business models, it is their position within a much larger structural shift, a shift towards space commercialization, toward satellite networks, toward advanced infrastructure, and toward a global economy that is becoming increasingly dependent on orbital systems. Rocket Lab represents launch capabilities, Redwire represents in-orbit infrastructure, XOVR represents diversified innovation exposure, Linde represents industrial inputs that make the entire system possible, and EchoStar represents the communication layer that connects it all together. As the SpaceX IPO approaches, markets rarely move in isolation, capital rotates, narratives expand, and investors begin searching for indirect ways to participate in the biggest structural trends. That is exactly what is happening here. Now the key question becomes this: among these companies, which do you believe has the strongest long-term advantage in a world where space becomes a core pillar of the global economy? Is it the launch providers building access to orbit, the infrastructure companies building in orbit, or the communication systems connecting everything together? Leave your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.